Recently, we got a comment from KI here on YouTube asking us to make a video on companies that we think will be going bankrupt over the next year or two. We also thought that this was a great idea. So in this video, that is exactly what we are going to cover. Which stocks do we think will be going bankrupt over the next 2 years? Now, full disclosure, we cannot say for sure if these businesses will in fact be going bankrupt or not with 100% certainty. But based on their fundamentals and their financials today, we think that there is a large chance of all of these different stocks going bankrupt. Also, before we get into the video, we just want to let you know that Stock Unlock will now be sending out a newsletter to our paid members as a way to add more value to you. We already send out a free weekly newsletter, and in addition to that, we will now be sending out a newsletter only to our paid members. This newsletter will contain our favorite stock picks and in-depth research on stocks that we find interesting. It's a way for our members to find new stock ideas and learn more about stock analysis. A Stock Unlock subscription is only $6.99 a month, and this will now include our stock ideas and analysis newsletter. So if you're interested in getting this newsletter, then head over to stockunlock.com and sign up for your subscription. And with that being said, let's now hop into the video and all of the stocks that we think are going to be going bankrupt over the next year. So the first one right here is HEXO Corp. This is a smaller cap company, and it currently has a market cap of about $117.7 million. Now also, if we take a look at the stock's historical stock price, in 2019, this was a $33 stock, okay? Now the stock is trading for about 17 cents, which means that the stock is down over 99%. It's down about 99.4%. If we zoom into about 2021 and just take a look at over the past year, this stock is also down about 98.3% over the past year. And honestly, I would not be surprised if this stock does end up going bankrupt over the next 2 years. If we head over to our Stock Unlock Insights right here, we can see that HEXO has a profitability score of only 1.3 out of 5, which is almost as bad as it can possibly get. The company's gross margin is negative 35%, so it's not even generating a profit by delivering its products and services. So it cannot even produce its products and services at a profit before even subtracting operating expenses. So this company is losing money on all fronts. It's not even close to becoming profitable. We can also see that the operating margin is sitting at negative 120%. The net margin is almost negative 500%. Free cash flow margin is negative 76%. And it's free cash flow negative, obviously. And it's lost $180 million just in the past year. And you got to think about this. This company is worth $117 million today. And over the past year, it's lost $180 million. So it's lost more than its entire market cap in free cash flow just in the past year. That is absolutely awful. Now, if we scroll down to our financial health, it's also got a score of 1.8 out of 5. So on top of this business not being profitable at all, it's also got really bad financial health. It's got a cash runway of less than 1 month. So basically at this company's current burn rate, it's going to run out of money in less than a month. Current ratio is also below 1. And the company has increased its share count by 254% over the past year. So since this business is losing so much money, it's unprofitable, what it has to do is dilute its shareholders massively just to raise money and stay in business. And over the past year, it's diluted its shareholders by 253%. So that is just ridiculous. That is destroying shareholder value so much. And I do not think that a company can continue diluting their shareholders like this without it going under eventually. Like eventually the market is going to be like, you know what, we're not giving this business any more money. We're not going to buy the shares that you are diluting. And when that happens, then HEXO will finally not be able to raise any more money. And that is really when the business, in my opinion, will go under. Now, if we also head over to the financials right here, I want to show you just how dramatic some of these figures are, okay? Right here in 2015, HEXO had about 7.3 million shares outstanding, all right? And in the most recent quarter, they now have 433 million shares outstanding. So over the past year, 433 million shares today divided by 7 in 2015 means that they have increased their share count by about 62x over just the past 7 years. That is an absolutely insane amount of dilution. This is the most dilution I have ever seen a stock do, to be totally honest. Now, what's also interesting is we've already learned that this company produces negative operating cash flow, right? I mean, their operations in the trailing 12 months lost 127 million. So just the operations of this business lost about $127 million, over $100 million. Then my question becomes, okay, if this business is losing money, like this business is losing hundreds of millions of dollars, then where is the money coming from? How is it staying in business? Like, how is it still affording to pay its bills and pay its employees? Well, if we take a look right here, it's because of the net common stock issued, which also makes sense because the share count is increasing so dramatically. So this company is diluting shareholders to raise money. And right here, we can see that in 2021, in the third quarter of 2021, the company raised $175 million from dilution. Then the next quarter it was about 24 million. Then the next quarter about 4 million. In the trailing 12 months, this company has diluted $250 million worth, which is more than double the company's market cap, which is also what we saw in the Insights tab. So this quite literally is where the company's money is coming from, is from diluting their shareholders massively. Now, what's also interesting is if we head over to the balance sheet and we take a look at the company's total cash position, we can see that the cash position spikes. And this is from dilution because think about it, the company is not making any money internally, right? So the business isn't generating money organically or internally. So for the money to increase, it has to come from somewhere from the outside, either through debt or through dilution. So whenever we see these spikes in the cash position right here, this is the company diluting. And then we can see that once the company dilutes, it raises the money, then the money slowly dwindles away, and then they do dilution to get more money, and then it slowly dwindles away again. And right now we can see that the company is sitting on about $14.2 million of cash as per their last reporting. This ultimately means that the company is probably going to run out of money here within like the next quarter or so. Because think about this, they got $14 million of cash and they're burning about $170 million a year in negative free cash flow. So they're going to have to dilute, or they're going to have to take on a lot of debt very soon. If they cannot get debt because no one wants to lend to this business, then that's a really bad thing for the company. And if they cannot dilute anymore because the overall market is just like, you know what, we're not going to be buying your shares, then that will make it really hard for the company to get money as well. And once those two options run out, then this company could it has a very real chance of going under and going bankrupt. I think that this is like the best example of a company that is on the verge of bankruptcy, straight up. And that is the reason why. Now, if we move on, the next stock that I want to talk about is BYND. This one is Beyond Meat. I've talked about the stock quite a bit before. From its all-time high of $234, this stock is now down about 95%. Just over the past year, the stock is also down about 88%. So this stock has been getting decimated in the market. And if we head over to our stock unlock insights, we can see that this company has a profitability score of 1.4 out of 5, which is also pretty dang bad. The operating margin is negative 65%. It does have a positive gross margin, but it's got a free cash flow margin of negative 117%, and it's lost $500 million over the past year. So this company is burning over $500 million a year right now at its current burn rate. Now, if we take a look at the financial health, based on Beyond Meat's burn rate, it has about 10 months left of cash. So over the next year, if they do not increase their profitability or, get closer to profitability and decrease their burn rate, then the company will run out of money at its current burn rate within the next year. And when that happens, again, the company is going to have to either dilute or take on debt to stay in business. Now, unlike HEXO, Beyond Meat stays in business from taking on debt. So right here, we can see that the cash from operating activities is negative. In the trailing 12 months, the operations lost about $417 million, okay? So just like HEXO, this business is not generating any cash within itself or organically. So once again, if the business is not generating any cash organically and it's losing money, then how is it paying its employees? How is it producing its products? How is it delivering its services? Well, we have to go further down the cash flow statement right here. And we can see that right here on the debt repayments, Beyond Meat took out $1.1 billion worth of debt in 2021 in the first quarter. So instead of diluting, what Beyond Meat did is they took on over $1 billion in debt. If we go to the liabilities, we can see that their long-term debt, or their liabilities, increased massively in the first quarter right here. And again, this is because the company took on that debt. Now, if we take a look at the cash position, we can see that right here, the company took on that $1.1 billion of debt. The cash position absolutely spiked. But what's happened since then? The cash position has slowly been coming down. Well, actually, quite quickly, it's been coming down. And now it's sitting at about $454 million left. So this is, again, what happens? These unprofitable businesses, they raise money and then they burn through all of that money. And if they do not get to profitability eventually, then money's going to run out. They're not going to be able to dilute forever, and they're not going to be able to take on debt forever. Eventually, banks and lenders are going to be like, you know what? No, we're not lending you any more money. Your business is going to, in fact, go under. Beyond Meat, I do think has a very real possibility of going under over the next 2 years if they cannot get their profitability back up. And the reason why I don't think this company is going to get its profitability back up is because if we take a look at their gross profit, actually, instead of this, we're going to go and take a look at their gross margin. We can see that since the first quarter of 2020, their gross margin has been going down. And in the most recent quarter, the gross margin was -4%. So this company's profitability over time is going down, and now the gross margin is in the negatives as of their last quarter. So they seriously got to turn something around. The business has to pivot, do something to get profits and organic cash flow coming in. And I don't think they're going to do it in time personally before they run out of cash. So I think this is an incredibly risky stock. This is not a stock I would ever own personally. And I do think that it has a real risk of going under. Now, the third stock that I want to talk about is OTLY. And this is another company that I just think has a very real chance of going bankrupt. So this stock IPO'd in 2021 during kind of the stock market speculation and hype that we were seeing. And ever since its IPO, it is now down about 85%. So it's lost 85% of its value over just the past year. If we head over to our stock unlock insights, it's got a profitability score of only 1.4. It does have a positive gross margin of 18%, but operating margin, net margin, free cash flow margin are all negative. And once again, this company has lost over $500 million in the past year. So it's burning about as much cash as Beyond Meat, and it's got no profits to speak of at all whatsoever. It's also got a cash runway of just over 6 months. So at the company's current burn rate, it has about 6 months left of cash, and that's how long the business has before it runs out of money. You can very clearly see that here on Stock Unlock. Now, if we head over to the company's financials and we head over to the cash flow statement, once again, we can clearly see that this company's operations are not making any money, and the operations lost about $269 million over the past year. So once again, you got to ask yourself, okay, how is this business staying in business? And if we take a look here, it's because when they did their IPO, they raised about $1 billion. What companies do is when they do their IPO, they sell shares to the public, and then they raise money from that. So that is how the company is staying alive right now. But what we can see is the company raised that $1 billion, and ever since then, it's been burning through that cash massively. And now it's sitting at about $275 million. So it's burned about, $700 million since it's been in the public stock markets just over the past year. And now it has $275 million left. The company is still losing, $500 million a year. So this is another company where they're going to run out of cash soon. That's just what the numbers are suggesting. And when they run out of cash, they're going to have to dilute, or they're going to have to take on debt. And if they cannot get access to funds through either of those ways, then the company is going to be in trouble. So what all of these companies have in common, these three companies right here, is that they're losing a ton of money. They're running out of cash. Their balance sheet, the cash position on their balance sheet is running out. They all have under a year left of a cash runway. So based on their current cash position and how much money they've lost over the past year, if they maintain those losses, then they're going to all run out of cash within the next year. And then they're going to have to dilute their shareholders more, or they're going to have to take on more debt. If they cannot do either of those things, then the business has a very real chance of going under and going bankrupt. So I think that all three of these stocks, OTLY, Beyond Meat, and HEXO, are seriously risky investments in the market right now. And with, debt becoming more expensive, and with investors being more bearish and not really wanting to invest their money or just lend these speculative stocks money, I think that these companies are going to have a really hard time getting their hands on cash. And by using our stock unlock insights, you can very quickly see that these are risky investments that are probably going to run out of cash within the next year if they don't turn something around. So yeah, those are three stocks that I personally think could go bankrupt over the next 2 years. And those are all of the reasons why. And that's what these stocks have in common. So if you enjoyed this video, then again, please remember to leave a like on it. And if you're new here to the channel, then please remember to subscribe to the channel to see more stock market related content like this. Also, if you are interested in trying out Stock Unlock, then you can head over to stockunlock.com, enter in your email, and you can get a 14-day free trial with no credit card required at all. you can come and play around with the entire platform, check out our insights, and see what we have to offer here for 2 weeks totally free. And I can guarantee you that if you use Stock Unlock for 2 weeks, you will become a better investor and your investments will improve. Also, if you are interested in getting our new newsletter that we're going to be sending out to Stock Unlock members with our favorite stock picks and in-depth stock analysis, then become a Stock Unlock subscriber for about that $6.99 a month, and you'll get that additional value on top of the entire platform right here. So yeah, if you're interested in that new newsletter, then come and become a Stock Unlock subscriber. But that's going to wrap up the video today, everyone. So thank you all again so much for watching. We truly do appreciate it, and we really hope to see you all again in our next video.